Hi, everybody. Heyo. Hi. Hey, it's good to see you guys. Shoshana, can you grab the lights that's right next to you? Thank you. All right. This may be one of the biggest Silicon Valley Bitcoin meetups that have ever been had. That's really awesome. I'm really glad you guys are here. I would typically give an opening remark. I don't want to. Tim Draper it has limited time, so I want to bring him up on stage. I don't think he needs any introduction. But go ahead. All right, someone who owns more Bitcoins than God, Tim Draper, and we have Preethi Casaretti, who runs a company called True Story, which is how we are live streaming this tonight. Preethi is able to provide live debates in the crypto space and outside the crypto space, but using a very interesting type of blockchain software. You don't need to get into that right now. What I do want to get into is Preethi and Tim talking a little bit about what he does as a Bitcoin VC.
All right. Terrific. Thank you. Is this working?
Hello. Awesome. Thanks, George. Awesome. So I was told literally 10 minutes ago that I'm going to be firesiding chatting you. So I'm going to wing this in the best way possible. And I want to keep this conversational between me, Tim, and the audience. And I don't think Tim needs an introduction, obviously. But I've been always curious to hear, I'm sure you give your elevator pitch to people. So what's your 30-second elevator pitch that you give to people when you meet people?
Hi, I'm Tim Draper. I'm raising money for my venture fund. No. I'll tell you what, it's a new thing. It's sort of evolved over time. But I'm on a mission, and I was on a mission way back when, and that was to spread venture capital and entrepreneurship around the world. There is plenty of venture capital around the world now, and plenty of entrepreneurs. No, never enough entrepreneurs and never enough venture capital. But my new mission came to me when Bitcoin started, when I started to realize that there were all these interesting new uses of Bitcoin. And I thought, wow, this is, as we all know, open, transparent, global, easy to keep track of, and it can be used for all these different things. But what happened to me was this thing that happened was I saw that the world had been tribal and it was starting to go global. And all of a sudden I realized I have a new mission, and that is to drive all those geographic borders down, to encourage businesses around the world, and to fund all those companies that are going to do those neat things. And it started in the finance fintech area because I knew that was going to go through a big change. And now I'm kind of looking for things in where you use Bitcoin or blockchain or smart contracts or artificial intelligence in all these other fields. And you want me to just keep going, or you want?
Good. So just curious, when did you first hear about crypto? What was that?
Well, it's interesting because it was really like 2003 when I met this guy from Korea who said, I'm living half my life in the virtual world, and the other half I hire a guy to be my avatar in the virtual world. He was playing some game called Legends. No, I think it was like Lineage. Sorry, it's called Lineage, and so he hired a guy. So when he's at work, this guy, his job is to be this other guy's avatar. And I started to think, oh wow, people are going to live on this ethereal plane, and they're going to live in this real world. And the ethereal plane will get more and more interesting, and the real world will be the same. And so that meant virtual real estate and virtual insurance and virtual currency and virtual government and virtual all these other things. And so I thought, oh my gosh, I need to find that digital money company, that virtual money company. And I was really excited about some of the games that had virtual money in them, but I kept thinking, well, when are they going to translate to each other and make it so it's a real currency that we can all use instead of just being in one game? And then Bitcoin came along, and it caught some momentum, and I ended up backing this guy at CoinLab. And I said, I also want to buy some of this Bitcoin, so how do I do that? And he said, well, I'll go mine it for you, or I'll use your money to go buy a chip, an application-specific chip, to go mine it for you, and we can get it for below market. Market at that time was $6 a Bitcoin.
Wow.
And now, and he said, we can get it for $4 a Bitcoin if you give me this money to buy the chip. So he went and bought the chip, but the chip wasn't delivered on time, and we were kind of going, well, what's going on? What's going on? Turns out that the guys who made the chip had front-run him and were producing their own Bitcoin with the chip. And meanwhile, Bitcoin prices went from 6 to 36. And then finally, we got the chip. And then he started mining with a chip. And we got some Bitcoin, and he kept it at Mt. Gox. And then they disappeared the money from Mt. Gox, and we were kind of out of luck. And I thought, well, you know, it was a good experiment. It was really exciting, and maybe something else will come along. But with that news that the biggest exchange in the world for Bitcoin basically stole, maybe, or disappeared all of that money, I thought that's the end. You know, Bitcoin's going to go to zero. But it didn't. It dropped by, that news dropped the price of Bitcoin by only 15%. And I thought, ooh, people really like this stuff. They need it. Even if they're going to lose like 40% of the value of Bitcoin to some theft, they need it. And so then I went around looking for what they're using it for, and it was like everything from, you know, drug deals to sending money to your poor grandmother in Guatemala. And then I really got interested, and I started to buy more and more. And I kind of talked myself up into thinking that this was the future. And then when the Silk Road auction came up, I bid, and I knew all my friends were bidding below the market price because they were trying to get a deal. And I was thinking, well, you know, this is a lot of Bitcoin. And so I bid above the market price, and I thought, well, maybe I'll get one. There were 9 lots. I thought, well, maybe I'll get 1 or 2 of these lots, and everything will be great. Well, I got them all. I got all. Be careful what you wish for. And so Bitcoin immediately went from where I got it at 632, I think up to 634, and then down to 180. And then, you know, of course, I did make that prediction that it would hit 10,000 in 3 years when it was at about 180, 200. And it did.
Yeah. And
like magic.
You mentioned that people wanted it. Like, what do you think, what makes this the right time for something like Bitcoin? Why do you think people want this so badly?
So there have been a lot of interesting, obvious uses. Sending money across border without paying Western Union 8 to 16%, and maybe quick transactions or something that had great promise but really isn't going to be available until OpenNode and the Lightning Network speed everything up, are going to be the microtransactions. That's going to be a major, major change where people are going to go, why would I want dollars? There's no microtransaction in a dollar. So that's what I'm thinking might be one of the key things, but let's say you are one of the wealthy people from Syria or Sudan, and you've got a bunch of Sudanese money or Syrian money, and the military comes in and takes your home, and you are pushed out, and now you've got a bunch of Syrian money, and you're in Greece, and you're a refugee. Well, if you had put, 10% of your money into Bitcoin, you could have just started your life over right there, and you would have some money, and you could get going, but instead you're stuck, you're a refugee, and you are stuck with fiat from a country that is going through a revolution. I think that kind of thing is a good example of how we are now in a world that is completely exciting and global, and the tribalism is going to lose its clout. And I want to go a little further with this thought of the tribalism losing its clout. When the great lion in the jungle starts fading, there's this final roar before it dies in the jungle, okay? So, and it's a huge roar, oh, everyone hears it. So what's happening now is the tribes, the people who are in power over the tribes are now looking and saying, wait, no, we can't lose our tribe. They're fighting to cling to their power over their tribes. And so they're doing things like creating a trade war or a wall or a whatever, when they know really that we're all very global and we can all do business across borders very easily. And they feel like, no, we've got to stop the dike, don't let any more water through, and let's control the people around us. And you're seeing the very high control politicians in power right now clinging to that old way of doing things. And we have a new world. And that new world is coming, and you guys all know it. And everybody knows that, hey, there's a better currency, and there's going to be better everything. You're going to have, let me go into one other thing before you hit me with a question. What is government? Government is your safety cushion. It's sort of the safe thing. We built these tribes to protect the people inside those borders. Well, so a lot of what government does now is insurance. It's healthcare insurance, and you're insured for your pension and your workman's compensation, all these insurance programs. Well, what is insurance? It's basically Bitcoin and a smart contract, and maybe some artificial intelligence to get out the fraud. That means that there are a whole bunch of bureaucrats that are going to cling to their job, try to cling to their job, while the more ambitious and forward-thinking governments are going to go, hey, I can compete across border. I'm Estonian. I only have 1.3 million people, but I can go market to 8 billion people an insurance program of some sort that's better than what they're getting, cheaper, more efficient, faster than anything they're getting from their own government.
But people fundamentally trust other humans. Do you think that will ever live in a world where we don't want to trust other humans? I think you're trying to move to a world where it's all digitized, all codified. I don't know, don't you think people always want to rely on some fundamental human being existing there, like the government?
Yeah, I think, as Reagan said, trust but verify. I trust you, but we're going to have to get to know each other a lot better before I hand over my Bitcoin or whatever. And so there is but who do I trust? Do I trust my government? Now you start looking, and it's the people who are older have if you do polling, the people who are older have very high trust in the U.S., in their government. People who are younger, very low trust in their government. They trust Bitcoin more than they trust a dollar. For people who are sort of 35 and younger, they're all saying, if I said, here, you can have $10,000 or 1 Bitcoin, most of them will say, I'll take the Bitcoin. If they're 50 or over, they'll all take the dollars. And that world, that just shows where the world is headed. But it also shows that, old people, it's hard for us to change.
So you're saying who we trust is changing.
So who we trust. So who do you trust? Do you trust a fiat government that decides politically how many of the currency to print, or think, I mean, any of you guys from Argentina? Okay, you know what I'm talking about. Okay, there's a great guy from Argentina who started Ripio, and he came to me and he said, that the government has basically, his family has built a fortune 3 times during his life, and the government's monetary policy has basically wiped him out 3 times. And he said, and I'm only 30 years old. So every 10 years, there is a currency wipeout in Argentina. And they've just announced, okay, I had a very interesting experience with the president of Argentina. I met with him about 3 years ago. And I said, you got to check into this Bitcoin stuff. You got a really bad currency, and you should really check into it and see what you can do. I came back about 6 months ago, and I said, remember about 2 years ago, we were talking about Bitcoin, and I said, so Bitcoin during that time has gone from 10,000. I was actually in Argentina when it was at 10,000 that day. It's gone from 10,000 down to 4,000. And he goes, uh-huh. And I said, during that time, the Argentinian peso has gone from 7.5 cents to 2.5 cents. And I said, so here's what we're going to do. We're going to make a bet. And the bet is that if the Argentinian peso does better than Bitcoin, then I will double my investment in Argentina. And he goes, uh-huh. And I said, but if Bitcoin does better, then you have to make Bitcoin a national currency.
Wow.
So, and then he looks at me like, what? And I said, the way Japan did. And he goes, get on the phone, ask those guys in Japan how that, anyway, he was a man of action for the moment. But now, you know what's happened, right? They've done just the opposite. They have outlawed the dollar. They haven't even, Bitcoin, they're not even recognizing, but they have outlawed the dollar. But this is a country where in Buenos Aires, they've also outlawed Uber, and there are 80,000 Uber drivers in Buenos Aires. So they're not always paying attention to what gets outlawed.
Interesting. So I think everyone in the room probably is here because they believe the future is crypto. But I think we're going through this phase where there's a lull. Things are not really happening yet. A lot of things don't have product market fit. And so where do you think in this journey we are to reaching this grand vision that you have?
If it works any way like the way the internet worked, we had the dot-com boom, and then Tony Perkins is here, and he predicted the bubble bursting, and then we had the bust. Well, we've had that in Bitcoin. Actually, we've had it like 12 times. But the big one was when it went from 20,000 down to 3,000.
Do you really think that was the big one? You don't think there'll be another one like that?
I think it'll rise higher and dampen less as we go. And so you won't, I don't think you'll see, what is that, 85% loss in that short a time.
I disagree, but okay.
Yeah. Well, good. You're braced for whatever possible thing happens. And I hope you all are, because this is going to be a rough ride. If you don't think it's a rough ride yet, you'll see it's a rough ride, because all of those people in power, all those government, whether they're in the bureaucracy or they're politicians or whatever, they like their power. They don't want to give it up. Fortunately, I've noticed in the U.S. they're saying things like, you know, I don't really like this Bitcoin, but I don't want to lose all the technology that we're going to gain from this. I think they do recognize that they want to let it rip because where the internet affected communications and information and gaming and entertainment, all sorts of industries, the biggest industries in the world are being affected by Bitcoin and the blockchain smart contracts and tie it to AI. And those are the ones that are trillions of dollars. That's finance, commerce, banking, insurance, and then healthcare. Actually, healthcare is remarkably, healthcare will be tied in with this as insurance becomes more the smart contract to Bitcoin, and the diagnosis in healthcare goes more from the doctor and trusting the doctor implicitly to big data and deep learning and artificial intelligence, where they're going to know not just here's your medical records and that's now online. It'll be here are your medical records, here's your genetic history, here's what your blood test results have been through the last year, and here's your Fitbit results, and this is the airplane seat you sat on your flight to Jamaica, and here's the, you know, here's what you ate, and this is the flower you smelled, and all of that. And those things are going to be, those environmental things are going to be much more important long term than anything you could possibly tell your doctor in the 5 minutes they let you tell them.
Fair enough. Going back to the government point, obviously we're in a phase where the government is fighting crypto. They don't want it to happen because, like you said, it'll destroy their power.
Now, some of the big countries, like China, really doesn't want it.
Yes.
The U.S. is kind of on the fence. Russia wants it if they can take it themselves. And all the small countries in the world are saying, I can fight above my weight here.
Yep.
And so you see, you know, Malta, Gibraltar, Switzerland, Bermuda, Japan, all saying, hey, this is a big deal for us.
Yep.
Yeah.
But my question is, like, the government, like China, for example, I think they're thinking about issuing their own cryptocurrency. Mm-hmm. And so if China does that, or any large nation.
Okay, you being somebody younger than 35, do you trust the Chinese government or do you trust your crypto?
I trust the crypto, but
okay,
I'm talking about the mass.
So then, always think of yourself. Don't always think of the masses, because
Okay.
you can't put your brain into theirs.
Yep.
Okay. So the Chinese government is now got their own crypto. Who's going to trust that?
The Chinese?
Chinese, maybe the premier, maybe the president. But I mean, if I'm Chinese, I'm kind of going, yeah, I don't even really trust my renminbi, you know.
You would think it's a generational thing where the current generation of Chinese might trust the Chinese currency, but my generation and below is going to want to trust something like Bitcoin.
Yeah, wouldn't you much rather have Bitcoin than some, you know, trumped up currency that some government official has decided
I would,
is
but
fine?
I guess, like, I'm looking out for, you're right, I'm looking out for the kind of the mass appeal, and my mom, my dad, grandma, they're not going to trust some random developer who shipped Bitcoin, but they're going to trust the government. But I can see your point of view that it's,
you know, it was way back when I remember my dad always saying, the government is us. We are the government, at least in the U.S. That was a big part of the U.S. And then he took me to a government office, and the guy behind the counter said, what can we do for you? How can we make your business happier? How can we improve your life at home? How can we improve your children's education? Those were the words out of his mouth. Has any of you heard that from any government official over the last 15 years? No, it's more, have you filled out my form? Have you filled out 15B and you didn't do it right? I know, because You didn't do it right. And so there's been, it's become a little bit of an us against them, and it's gotta be, we all need to start to bring it back. And I think the way we bring it back is to create this decentralized world so that they know they have to compete with all those other governments. And then they'll be just like, you know, the various businesses who have to compete with other businesses to provide the service for customers. They will start looking at their constituents as customers rather than as their subjects. Yeah, good word.
Absolutely. I think what crypto does, it shifts power back towards the people. And I think that's the powerful part about crypto. It's like all of us are now saying like, fuck you government, like we have our own tools, our own technologies to figure this out. Like we don't need you, and that's powerful. My next question for you is like, outside of Bitcoin, what are you thinking about or looking at from an investment point of view, or just like intellectually curious in crypto?
So I've sort of told you I'm looking for this new decentralized world. I will try to drive that with my investment decisions. So if it's a big enough idea, if it's a big enough market, unique enough technology, a driven entrepreneur, and it looks like they might be able to change the way we all think about something and move it in that decentralized direction, those are the kinds of things I'm going to be looking to invest in. And that can be in any of those major fields that I mentioned. And I am looking for GovTech. We've had a few, but we haven't had a ton. We backed Unstoppable. Has anybody looked at Unstoppable? Okay. Unstoppable is free speech for all, everyone in the world. So go ahead, you can get the thing. Yeah, you can get your domain and nobody can stop whatever it is, whatever the message is that you want to spread, no one can stop that. And that is a really powerful thing. And they can't stop it. That's why they call themselves unstoppable. And I thought that was kind of interesting. So spreading free speech around the world, that's a pretty big mission. And I like it. And then I'm looking for those opportunities where in healthcare, where you can actually get free virtual healthcare, at least the diagnostics part of it. I think that's kind of a really cool thing. And then I'm kind of hoping that we see more in Bitcoin. I'm hoping we see more things that are attaching accounting to the blockchain so that all that accounting is done. Long term, what I really wanted to do, I tried to do this and then I realized I had to pay double accounting and double legal to do it. I wanted to take investors all in Bitcoin, invest the money all in Bitcoin, and have the entrepreneurs pay their employees and suppliers all in Bitcoin. And naturally, we all think, oh, that's perfect because all the accounting's already done. You don't need the accountant, you don't need the lawyer, you build, and I could build in with my limited partners a smart contract so that if a company was sold, all the money would immediately just go into all of their wallets through a natural waterfall. Well, turns out the accountants make you change the Bitcoin to dollars, pay the capital gain, change it back to Bitcoin, and then the lawyers get involved and they're all excited because they're saying, oh my gosh, this is fantastic. All of these terms that we have, we can double the number of terms because we've got because now we got another currency that we're dealing with. So it comes out in dollars and it comes out in Bitcoin. They're two different things.
Yeah.
So what I'm hoping is that we move toward that. So I'm looking for engineers who are moving toward that, where we can, because at that point there won't be, it will be very difficult for the government to have an argument that says you have to go through a big 5 accounting firm and you have to do this legally and this, because it'll all be a deal on a smart contract and we'll all be kind of better off. And I think here's how you get the government on your side. You build in a little tax. And the way you build in that tax is on transaction. Every transaction, you build in a little tax. There was this guy who ran for president. His name's Scott Smith. I don't think he got any votes, but he wrote this great book, and the book was all about the fact that if you had a transaction tax, it could be 0.5%, and it would pay for twice what the government gets now, and you'd have that much more liquidity in the marketplace. So, and you wouldn't have to have any of those other taxes, and it would be automatic. And now he realizes that Bitcoin is his savior to get people to try this, and now he's running that up the flagpole in Washington. You know, let's all, you know, give him some positive vibes.
Super cool. I have one last question. It's going to be a yes or no question. Obviously, Bitcoin was the first cryptocurrency, and a lot of people believe that there's nothing that can compete with Bitcoin. Do you believe that Bitcoin is here to stay, or do you think there's potentially another cryptocurrency that can become the next fiat?
Oh, I think there already are a bunch of other currencies out there. I mean,
The dominant one. Can anything beat Bitcoin?
Well, you know, what's interesting is in the internet, when it would have been like saying, can anything beat AOL? Yes is the answer. And if the Bitcoin engineers aren't working super hard, they won't keep their dominance. But we have gone through the big boom and the bust, and Bitcoin is the real strong survivor. And so it does look very strong. It looks really good for Bitcoin to be one of the major players. That doesn't mean that you're not going to see something, Ethereum or Tezos or EOS or something become something really important. Or maybe even, you know, maybe Facebook's thing starts to work. I don't know. But I think we've got, the game is afoot. I think the competition is on, and we all know that this is just a better way to do business.
Yep.
And it's frictionless, and it'll make the world a much richer place, because a frictionless society creates a better economy. And so, you know, going from shells to gold was a major breakthrough. Going from gold to the promise of gold, major breakthrough. Getting credit cards, another major breakthrough. This is another major breakthrough. So, cool. I'm glad there are all these Bitcoin hodlers.
Thank you.
Thank you, Tim, for letting us be in your castle. Much appreciated. So that was really great. One more round of applause for Tim. All right, thank you. So, Jerry, you can go back. You can go back one.
I'm Tim at Draper.vc. Saves us all a lot of.
Okay. Jerry, you can go back one slide, by the way. Yeah. So the talk I wanted to give just before Tim went on, because we were going a little over, and I promise this will be short. This meetup today is about venture capital and exchange. Exchanges are the lifeblood of what Bitcoin could be. They need to be the lifeblood of what Bitcoin could be. So I prepared just a little thing I want to read to you guys. So why does Bitcoin have value? What really are investors speculating on? Well, they're speculating on future speculation. That's it. It's that simple, all right? But the future speculation of what? It's future utility. So if you look at the fundamentals, it boils down to the intersection of only two properties: censorship resistance and sound money. I'll repeat that. Bitcoin's two fundamentals: censorship resistance and sound money. This means that speculators are valuing Bitcoin's present and future ability to privately and trustlessly transact sovereign wealth. Any Bitcoin company CEO who tells you that they're Bitcoin first, but gets excited with the prospect of the Fidelities of the world bringing crypto mainstream is forgetting these fundamentals. I know that sounds strange, but I'll explain. Most crypto companies that are custodians in the US who collect know your customer info, But then they have to work extra hard because it makes them not just honeypots for crypto thieves, but also honeypots for sensitive, personally identifiable financial data. You can say, but that's separate from the value of Bitcoin. But I posit that systematic and systemic vulnerabilities at the service layer can be just as detrimental to Bitcoin's value as a vulnerability in the core protocol itself, just as detrimental. So imagine some of your transactions natively leaked your identity without consent on the Bitcoin blockchain. Or imagine it allowed some stakeholders to block certain wallet addresses from placing valid transactions. Well, trust in this kind of network would break immediately, and we would see the price drop to the floor like a stinking turd. But our antiquated financial system allows this and operates this way. And we're improperly attempting to fit Bitcoin's square peg into a regulatory round hole. When we hear mainstream Bitcoin adoption, we don't think too clearly about that end game. We simply cheer on the large banks and the custodial exchanges and the regulation-friendly crypto services who announce that they've ushered in the next wave of retail investors. But let's for a second picture just what that end game really looks like. Let's imagine a world where regulated gatekeepers held the only access to crypto. If that were the case, these gatekeepers can shut down accounts at will. They can block transactions. They can reverse your revenue. This becomes censorship at the service layer, which can be just as detrimental to the utility of Bitcoin as censorship problems at the protocol level. And exchanges are no exception. The long-held FATF travel rule that has been used by 36 countries to report customer identity information on any $3,000 transaction has now just been officially applied to crypto exchanges 1 or 2 months ago. But no conclusions on how to implement it technically. And even if exchanges figure out a way to fall in line and report off-chain, or God forbid, on-chain, where your customer identity becomes laser etched into your withdrawal transaction for all eternity, it obviously shows a fundamental misunderstanding of how transactions within permissionless, pseudonymous blockchains actually work. So when that was announced, BTC dropped almost $1,000 that day. We all know that markets react wildly to any geopolitical news involving Bitcoin because despite exchanges having been the biggest enabler of adoption by providing mechanisms of trade, exchanges are actually the most vulnerable link in our Bitcoin system. Not because they can and have lost billions of our funds to hackers and incompetence and shenanigans, but because they, as gatekeepers, succumb to the same banking regulatory scrutiny that leads to shutting down accounts, blocking transaction, and other censorship activity. This will slowly erode Bitcoin's universal utility and therefore undermines its monetary value. So why would we continue to go to a racetrack if the horses that we're betting on are all malnourished with broken legs? That's what Bitcoin would become. At that point, what is it that traders are even speculating on? But I'm not sure if venture capitalists see things this way. Hundreds of millions of dollars have been pumped into services like Bakkt, Tagomi, and others, and they'll prime the pump of adoption, and they'll reap a large reward for such a feat. But would it be short-lived? Where along the adoption curve would the Bitcoin that we know sunset and give rise to nothing more than a millennial-friendly digital stock market 2.0? So here's a crazy thought. Could these VCs be investing today in the very companies that ultimately neuter the Bitcoin that they thought they were upholding? So tonight, here at another historic Silicon Valley Bitcoin meetup, we brought in some of crypto's top investors to touch on this, their thoughts on the future of exchange, and more. My hope is to garner conversation on how to support Bitcoin trade for all. Not for some, not for the privileged, not for first world citizens with social security numbers and credit card accounts, but all. If the price on exchanges is linked to the speculation of Bitcoin's future as self-sovereign money for all, then imagine the price set by shifted expectations that all really means some, and Bitcoin becomes nothing more than bitness as usual. And that is why I wanted to put this together today. So I was going to, I guess the way to put this up, the next speaker that we're going to have is a company called Portal. And what they are doing supports Bitcoin trade in an unstoppable fashion through atomic swaps. And they will explain exactly what that is. So I'd actually like to call up Chandra Dugarala, he's the CEO of Portal, and Eric Martindale, who has been from Blockstream and BitPay, who's been working on this technology along with Portal. So I'm going to bring you guys up. Chandra.
Let me start the presentation.
We got to plug you in.
Oh, yeah.
Sorry.
I have been told that after this, there's the panel with some exchanges, founders of custodian companies, and some venture capitalists as well. So I'm going to start by making a very cheerful prediction, which is Bitcoin is going to fail, and that custodians and centralized exchanges are going to kill it. Because uncensorable money needs unstoppable exchange. My name is Chandra, and I'm the founder of Portal. We have a goal of developing products that take Bitcoin to 1 billion people, products that people actually love to use and want to use, and the goal is to make Bitcoin unstoppable. But before we get there, we have to take a step back and ask ourselves, can we actually create a new money? Well, if we can create a new money, how can we do it? The first thing we can do is, if you're a government, you have unlimited guns and power, you point them at a lot of people, and you force them basically to use your money, no matter how super high quality it is. Or if you have unlimited patience, you can actually wait for a commodity to evolve into a money, a commodity with the best monetary properties. But if you don't want to wait a few hundred years or 1,000 years, Bitcoin has no options. Kinda, right? So pay attention. I'm actually going to show you the secret map of how Bitcoin becomes money. In fact, it is so secret that it is programmed right into the protocol. Are you ready? It is this graph. It's quite simple, actually. It is the price hash rate spirals, or we call them speculative cycles. Increasingly larger speculative cycles is how monetization of Bitcoin happens. Every time there's an increase in demand, there's an increase in price that brings in more hash rate because of the profit opportunity for miners, and so on and so on. And this is going to go on, bringing more people and more money into the system until Bitcoin becomes money. The thing that powers this transition, the engine that powers this journey of Bitcoin to becoming a generally accepted medium of exchange, is trade. But the problem is almost all of trade today flows through centralized exchanges. And as George has touched on, and I think maybe Tim might have touched on this a little bit as well, they are a systemic vulnerability. They are a systemic threat to the adoption of Bitcoin. And that is precisely because, I can make the academic argument, but I'll give you the gist of it. When the big bad government wants to come for your Bitcoin, what do you think they'll do? I'll give you an example of what actually was done in India recently. They didn't like the fact that Bitcoin is competing with their favorite sun, which is their local Indian rupee. And they didn't try to exploit a BGP vulnerability and do a network level attack. They didn't actually start secretly mining and do a 51% attack. They didn't do any of those things. They just shut down exchanges and then pretty much took away all of the trade of Bitcoin in India. The more academic argument is they compromise censorship resistance because they can actually censor transactions. If you and I are just exchanging IOUs, that the exchange tells you you have 5 Bitcoin, I have 7 Bitcoin, that's just an IOU, it's just an entry in their database. It is not on-chain data. If they hold your Bitcoin for you, we're all just trading in scripts or banknotes, so to speak. And they mean nothing. They can arbitrarily seize your account and confiscate your Bitcoin. Even, whether it's malicious or under threat from a government, who knows? The second thing is decentralization. If these big economic nodes start to hold a lot of users' Bitcoin in custody, and if they're the only ones, or maybe at least one of the few that are accepting Bitcoin, the one who accepts Bitcoin, the merchants are the ones who enforce the rules. And those who enforce the rules get to change the rules. So this makes a situation like the New York Agreement, where a bunch of big players got in a room and decided to change the rules of the protocol, much more likely, and it's also going to make it more likely to succeed. From a user perspective, nobody wants to remember like 17 different login credentials, passwords, two-factor auths on like a whole bunch of devices. It's not a good experience, but that's the best we got. So what do we do? Do we do decentralized exchanges? Well, the good news is they've been dead on arrival. They've never taken off. This is the volume of DEX trades versus centralized exchanges. They've never actually exceeded 0.05% of centralized exchange trade volume. Intuitively, most of you who've ever tried to use decentralized exchanges know this, that the experience sucks. And why does it suck? Well, they have no good wallet integration. They can't do trades of assets across chains. They're prone to front running and order cancellations, et cetera, because they expose the order data at every node. On-chain transactions, they're very slow, bad UX, they're messy, and rightfully, they haven't taken off. So should we just try to fix the DEXs? I actually think we should be done with DEXs and move on. And the reason why is we don't really need decentralized exchange. What we need is trust-minimized exchange. The problem with centralization is that for a fair exchange, you and I need to give our asset custody somebody else who then makes that, facilitates that swap. The problem when you decentralize the exchange is that you lose the benefits of centralized exchanges, like speed, liquidity, user experience. And those are why we even go to an exchange in the first place. So with DEXs, you get trust minimization, but you lose everything else. That's kind of not the point. In fact, we want to preserve these benefits of centralized exchanges, right? It's a two-sided marketplace. More buyers on one side, more sellers on the other side. Each side benefits the other. That's the classic two-sided network effect. In fact, it's the prototypical study of network effects in economics. We want to preserve that. We want to just trust minimize that process. And how do we do that? Do we have the tools? Well, some of the tools have existed for a long time, starting with the Tier-Nolan atomic swap. This dates back to 2013 Bitcoin Talk Forum by a gentleman or someone named Tier-Nolan. And this construction basically is quite simple. Alice has some Ethereum. She wants to buy Bitcoin. And Bob has Bitcoin. He wants to buy ETH. What Alice does is she takes her ETH, locks her ETH in a smart contract using a secret that she randomly generates, and uses the hash of that pre-image to lock up her Bitcoin with the following conditions. Within a day, actually within 2 days, Bob can reveal the secret that Alice only has and take her Ethereum, or after 2 days, she can refund it back. It's called HTLC, or hash time lock contract. Then she passes the hash of that secret to Bob, who locks up his Bitcoin in the same thing on the Bitcoin blockchain, another HTLC, using the hash of the same secret with the condition that within a day, Alice can claim his Bitcoin, but to do so, she needs to reveal the pre-image. If she doesn't, Bob can refund his Bitcoin back in a day. Then the swap is triggered when Alice simply claims Bob's Bitcoin. To do so, she has to reveal the secret. And now Bob knows the secret. He has a day to take that, at least a day to take that, and then claim Alice's Ether, right? So assets changed hands. Nobody held custody. They were both held on on-chain smart contracts. The problem is, every discussion of these Tier-Nolan swaps starts with a lot of hand-waving and assuming away that people who want to trade have somehow found each other, right? They've agreed to trade. They've agreed on the order size. They've agreed on the price. And then now let's just discuss the problems with the transaction construction. That's kind of like saying a lot of people want taxi rides. A lot of drivers have idle capacity. Let's just find the best way to process these payments. Screw the user experience. Uber wouldn't exist. The second problem with tier Nolan swap is, if you remember back to the timing, Alice, for one day, had the option to claim Bob's Bitcoin by revealing her secret. But she's under no obligation to do anything, right? She can purchase an asset for a fixed cost on or up to a specific date. If you're versed in finance, you know that it's called an option. It's called an American call option, to be more specific. And options aren't free, they have a price. It's called a premium. Nowhere in this protocol does Alice actually pay the premium. So the free option is a source of inefficiency in the tier Nolan swap, and liquid markets don't like inefficiency. Second thing is this thing called liquidity trolling or lockup griefing. So let's say Alice had every intention of following through with her commitment. She's a nice person. She intends to finish the swap. So she locks up her ETH for 2 days, takes her pre-image hash, passes it to Bob, and Bob is just going to smoke a joint and Netflix, right? He's not going to do anything. He doesn't need to lock up his Bitcoin in an HTLC. So he essentially has tricked or trolled Alice into locking up her liquidity for 2 days for free. The other problem with tier Nolan swaps or cross-chain swaps is that I wanted to say the UX is terrible, but there isn't even a UX, so there's not much to talk about. So the goal, so what we do is we want to make, or we've actually made cross-chain atomic swaps as easy to use as Coinbase, and they're integrated right into your local multi-currency wallet. So there's no complications. I'm going to give this to Eric, my friend, to actually show you how this works from a UX level and give you a little bit of the mechanics, and then I'll finish up as to what properties it gives you and what benefits you get as a user.
Awesome. Thanks, Chandra. All right, so my name's Eric Martindale. I do see some familiar faces in the audience, but I've been working in a space for a while. I got the fortunate opportunity of actually being invited to go work at BitPay originally at the end of 2013. For those of you counting, that was when the price, I believe it was went from about $250 to $1,200. And so this was kind of the moment, right? I had been the crazy uncle for, a couple years before that. My parents almost kicked me out of Thanksgiving dinner because all I wanted to talk about was how Bitcoin was going to be the future, and all I wanted to do is talk to the local businesses and convince them to accept Bitcoin because this dirty state script surely wasn't going to stick around for a while. So I had all sorts of high hopes and aspirations, and I really wanted to figure out how do we properly decentralize these ideas, right? How do we take the existing applications that are suffering from what I saw to be counterparty risk, the aggregation of personally identifying information in central points, where rather than an attacker, going around and stealing the wallets of every single one of you, all they have to do is one fell swoop into the big honeypot, and it was easy. At BitPay, I actually had the opportunity to work on some really cool projects. I was responsible for open source while I was there. We got the opportunity when the sidechains white paper came across. We wrote one of the first implementations. We announced it as ChainDB. Not to that much fanfare because I don't really think the industry had sophisticated far enough at that time. But we also worked on a precursor to the Lightning Network using these concepts called payment channels and the HTLCs that Chandra kind of talked about, called the Impulse Network. And, I really got the exposure and the opportunity to work with some really cool people, but the business bent, like trying to go down the direction, ended up with a lot of our open source work just not receiving the attention and the focus that it deserved, right? A business has to make money, and so BitPay went on to focus on payment processing. So I took the summer of 2015 to found Fabric Labs as an attempt to solve this problem. And so when my friend Chandra actually reached out to me, he had seen some of our work, some of the approaches that we were going to take. And I'm a very technically oriented person, right? I started with the engineering aspect. So I came at it from the engineering perspective, but just like I told Roger Ver in 2014, and because I was frustrated with, having to wait a certain number of confirmations for a transaction to be secure. I was like, there's no way that a user is going to wait around for any amount of time, let alone 6 confirmations for the thermodynamic security that you want out of a system. So I said, Roger, man, user experience is the #1 thing that we got to solve. Okay, we have to solve it. And he kind of nodded and laughed a little bit, sure enough. But Chandra, he had a user experience focus. So what we did is we went ahead and used some of our technology. You're going to see Alice and Bob here. We're looking at Bob. He's got a Bitcoin balance. Now, these are what we call layer 3 contracts, okay? So layer 1 we look at as the settlement layer. This is where Bitcoin is bonded into layer 2 HTLCs. These are your smart contracts. These are the mechanisms that you can use to instantaneously make a transfer to someone. So here we have Alice. She is going to offer up some of her Ethereum into this layer 3 contract. She already has a balance here at layer 2. So this is a payment channel that's established with the network. She's going to set her pricing information based on what she perceives to be a good price, because this is a startup and we don't have a full order book yet. So that order goes into our order book. You'll see that the amount that she's bonded is actually 110 ETH here. The price is specified by the total amount of Bitcoin that she's requesting to purchase. So we're switching over to Bob right now. Bob does a very similar thing. And he's going to click this accept swap button, which is going to fill out the opposite side of the trade using his layer 2 balance. Now, the innovation that we've done here is, how do we protect the privacy of these users? How do we actually ensure that these people they're protected in the same trust minimized fashion that we're looking for? So I'll get into the technicals here in just a second, and I'm going to cover it as quickly as I can, but we're open to questions afterwards, so give me just a minute. What are the properties that we're looking for, right? We want deterministic execution, right? We want to be sure that this program executes exactly as the traders are expecting, that the order book is sorted appropriately, but that the pricing information is not revealed, okay? What we don't want for this sort of generalized computation thing that we're building is we don't want those messages to be passed around to everybody. We don't want everybody in the network to be computing every contract. That would be terribly inefficient. We also want all of the properties that a traditional exchange might have, which include order aggregation, so taking multiple orders from many different places and pulling them together. And we want partial filling, right? So a Bitcoin transaction is not going to be valid until the sum of the outputs is equal to the sum of the inputs. So how do we do this? Briefly, I talked about this. We push all of the payments into layer 2, and we just simply rely on the layer 1 as the finalized settlement engine. This is very similar to the other layer 2 systems that you're going to see on the internet, including Lightning, most sophisticatedly. On the Ethereum side, I haven't actually really heard that much out of it, but there is also Raiden. And I also consider other side chains, such as Rootstock, to be layer 2 systems, because they do ultimately connect to a base layer. So we've designed something called the ZK swap. And what that is a zero knowledge, that's the ZK piece. While it runs, I'm going to just kind of skip forward here. So what you're about to observe is a distributed contract which is being run by multiple parties in the network. I'm going to just speed it up here just so we have the time. So what you're observing is the actual network executing the slices, the pieces of what's called a MPC, or multi-party contract, where the higher order program, probably written in a programming language that you're familiar with, is compiled down into a layer 2 circuit, where members of an open network are able to compete with one another for computing portions of that contract. Now, because we use a property called homomorphism, which is the ability to encrypt a piece of information, pass it off to someone else as encrypted information, run some program over that encrypted information without ever decrypting it or revealing to the party who's computing that, and then return an encrypted solution back to the original requester, okay? And in doing so, we create something called a zero-knowledge contingent payment, where because I can prove that I executed this encrypted program correctly, I executed the multi-party circuit correctly, I can lay claim to some funds that were originally offered up by the creators of this transaction. This is the fundamental idea behind Fabric, a layer 3 system. So you're actually seeing the transaction being created here, composed, and then broadcasted out to the layer 2 network as those parties facilitate that trade. So what this does is you'll see Charlie being added here, and Charlie is actually able to see these orders, and now they're partially filled. On Bitcoin, we have something called sig hash single, which is a signature mode, which allows us to only have one input in the transaction, which is signed, and then we use another part of Bitcoin that allows us to have only one of the outputs signed. But we can also set the total amount in the transaction, so it's not considered a valid transaction on the Bitcoin chain until those inputs and those outputs have been filled. So our zero-knowledge circuit here, what its responsibility is aggregating these orders in an encrypted way, sorting them, breaking them down into fundamental units, what we call the unit type, and then ultimately computing what the final solution for this distributed contract is without ever revealing any of the underlying components. So with that, open up to questions afterwards, but I'm going to hand it back to Chandra at this point.
Thank you, Eric. That blows my mind every time I watch it. So I want to talk a little bit about what this system does from the technical properties, right? First thing is we talked about facilitation, right? We hand wave away facilitation. Nobody ever thinks about it in the tier null and atomic swap. In this system, Charlie, the executor that he was describing, is a neutral third-party facilitator whose rational economic interest is to facilitate a swap between parties he doesn't know. And why does he do that? Because he actually gets paid only when he executes the swap. Any other branch, any other use case, any other possibility where the swap can go wrong is zero revenue generating. So there's an incentive built into the protocol to facilitate swaps. And anybody can do this. Anybody who provides resources to provide the circuit, execute the orders, do the sort, can do this, and they get paid a fee. And so essentially, you're creating a market in facilitating atomic swaps. There is no off-chain identity or reputation that you depend on. You don't need to know who they are. If you execute the protocol correctly, your funds will be safe, no matter who they are. And they can be completely anonymous or pseudonymous. And because they're anonymous, you don't know if the counterparty is acting as the role of the executor as well. Are they colluding? Are there two distinct parties, Sybil attacks? We don't know. We don't really care, because two out of three parties, Alice colluding with the exchange, can't steal Bob's coins. Bob colluding with the exchange can't steal Alice's coins. Alice and Bob can't collude to screw the exchange out of its rightful exchange fee. And there is no free option here, because the cost of the option is internalized into the swap itself. There's two ways to eliminate the free option problem. One, you have to eliminate the option itself, which you can't do in cross-chain, because completely closed blockchains, they don't communicate with each other. One chain doesn't know what's happening on the other chain. But what we've done here is we've internalized the cost of the option. So Alice actually pays the premium for the option that she's getting for the swap, but she actually doesn't have to calculate the price of the option or the premium. You know, who's here ever done binomial options pricing or Black-Scholes or stochastic pricing? I mean, I've never done it. Nobody wants to do it. As a user, you don't really care, right? Here, the facilitator is actually incentivized to accurately price the option, because if he prices it too high, Alice is not going to buy. If he prices it too low, Bob is not going to take. And because the only revenue-generating case is a successful swap, that burden is offloaded to the facilitator, who's also incentivized to do it. So that's actually what we can do today with cross-chain atomic swaps using just the assets on these blockchains. But the future is going to be many different arbitrarily complex financial instruments built on top of these blockchains. futures, derivatives, options, who knows what else, right? I can't even imagine. Stuff will be built. The one thing they all have in common is that they need a trust minimized layer of exchange or unstoppable exchange, and that's what our goal is to build. So I want to summarize by saying uncensorable money needs unstoppable exchange. That's our goal. We want to make it easy enough for everybody to use and make a product that people love to use. All of the, most of the building blocks to do this have been available for a while, but you need to put that together and productize it in a way that is delightful, easy, simple, accessible to users, and it's ready now. Thank you.
All right. That is Portal, and that's very cool because exchange is the most important thing to Bitcoin's life. And right now, we're going to have our crypto VC panel. So I'm going to ask our crypto VCs to come on up, and Preethi from True Story to come on up, and we'll get everybody here. Come on stage, everybody. Thanks, Eric. These are some very exciting people, and I'm only getting to meet some of them for the first time tonight, which is cool. I'm gonna pass out. Oh, do you want to stand? Is that what you want to do?
Sure.
Got some mics. Everybody turn them on. One thing I needed to make an announcement about. After the panel, we're going to have 1-minute lightning talks. People have registered on the Silicon Valley Bitcoin website to make an announcement. That's what a 1-minute lightning talk is. So after the panel is done, you can come up and line up and give those talks, and people can go back and eat the rest of their pizza and make sure you finish it, okay? And we're going to get on with the crypto VC panel. Thank you.
Thanks, George. Awesome. So I'm super excited to moderate this panel about exchanges, centralized exchanges, decentralized exchanges, with some prominent crypto investors. So before we get started, I'd love to give each of them 30 seconds to give a quick background about yourself, and then we'll go from there.
Cool. My name is Hasib. I am an investor and an advisor to Metastable Capital, and before that I was a software engineer.
I'm Joey. I'm co-CIO at Pantera Capital, and I also started Augur, and you should look out for Augur V2 Q1 next year.
Cool. Hey, everybody. My name is Chris McCann. I'm the founding partner of a fund called Proof of Capital, or VC focused on the crypto and blockchain space. And then I previously used to work at a bigger VC fund here called Greylock Partners, where I worked on a lot of the emerging tech sectors we're looking at, including all of our Bitcoin investments we made in 2013 and 14.
Hi, everybody. My name is Will O'Brien. I'm an angel investor, crypto investor. I was the original founder CEO of a company called BitGo back in 2013 to 15. And as an individual, I'm an LP and advisor to Blockchain Capital, and I also advise other funds in Silicon Valley. I have companies in Korea. I'm a judge on a TV show called Block Battle in Korea. That's kind of fun. It's like a Shark Tank for blockchain. And last year, I made about 28 investments, companies like Telegram, Orchid, Akash, Nodal, Hub here, and then also funds in London and Korea. So great to be here. Thank you.
Awesome. Thank you. So the conversation today is supposed to be about exchanges, and specifically DEXs. And centralized exchanges are probably the only thing in crypto that has product market fit today. Like, probably the only thing. And so we have a bunch of investors who have been thinking about what is the future of exchanges, and so we're going to go through a bunch of questions to grill them on the future of exchanges. But before we get into that, there might be some beginners in the room, so I want to take a minute to allow Hasib to explain what exactly is a decentralized exchange.
Cool. Okay. So I'll give myself a minute to do that. So a centralized exchange is basically the simplest thing you could think of. Everybody on these different blockchains sends money to a guy, and that guy has a website where people can post bid asks, and they decide who gets the money, and then that guy gives people their money back when they ask for their money back. So the guy, the company, whoever it is who runs the centralized exchange, they basically control everything, and everybody needs to trust that person. That person custodies all the funds, meaning that basically while everybody has deposited into the exchange, that company or person has control of everything and can screw everybody over if they want, and this has led to famous disasters like Mt. Gox. So a decentralized exchange, the interest in decentralized exchanges really began after Mt. Gox, is this idea that can we still get the ability to build these financial platforms, which clearly people want. There's a lot of demand for them, like Preeti said, but we don't want to give that much power to any single individual just for facilitating trade. And so what a decentralized exchange does is on a platform like Ethereum is the most obvious example, you can actually just code up the rules in a smart contract to allow people to directly engage in trade. And so there have been more and more DEX designs as of late. I mean, one of the very earliest ones was Ether Delta, which famously did everything on chain. So every single order was actually placed on the blockchain. But now DEX designs are more complex and allow a little bit more better throughput than what Ether Delta allowed. But that's basically what they all do, is they don't directly control your funds. Some smart contract does.
Cool, thank you. Okay, so we have this grand vision to build these decentralized exchanges. And what does the landscape like that look today? Like, what percentage of exchanges are centralized and what percentage are decentralized?
It's like 95.96% or so is centralized, and maybe 4 basis points is decentralized right now.
Wow, that's horrible. Why is that?
I mean, I would say the user experience just isn't there for DEXs. So if you go and try to use one, it's much slower. Most of them are based on Ethereum, so you can't trade, Bitcoin and Litecoin and other assets on them. And as a user, you face all these problems like speed. If you think of marketplaces, being able to modify and cancel orders very quickly is really important. On DEXs, those actions are either slow, in the case of something like 0x, or they cost money in the case of an on-chain DEX. And so it results in not very liquid markets, and illiquid markets is a bad experience when you're designing a trading system.
Really cool. And as investors, are you thinking about investing in both centralized exchanges and decentralized exchanges? Like, what's your sort of thesis around where you invest?
Yeah, at least me in particular, like I tend to be more empirical about things. So the most important factor when looking at a new exchange is the liquidity, trading volume, absolute number of traders, and does the founder and sort of CEO and team, can they actively actually do real user acquisition on that community of people that matters? And again, I guess maybe to take a more slightly controversial statement, I personally actually think the sort of core value prop that DEXs try to aim for is self-custodial. So don't give your funds to an exchange, hold it in your own wallet. You don't have to sort of trust the party or the person, so to speak. At least in my opinion, just looking over the landscape of DEXs for the past few years, that value prop is not motivating enough for people to switch over. I don't necessarily think it's a technical or architectural issue. I just think that value prop doesn't resonate with real traders. And maybe it's just because I spend a little bit too much time in Asia, like knowing a lot of the people who trade sort of significant volumes in crypto. But like that's not something that would get them to switch over, even if it was purely and perfectly fast.
Do you agree?
Yeah, I'll jump in that by analogy. So in 2013, when at BitGo we were pioneering multi-sig technology, which everybody knows what multi-sig is right now, nobody cared. Nobody cared about multi-sig because the price of Bitcoin was low, and they said, my CTO has the keys, we have cold storage, we're fine. And ultimately what needed to happen was a number of hacks on exchanges to wake people up that they should be using multi-sig. The realization it's hard to build that, so you should use a service provider who has things like insurance and standards, and that's their job. And ultimately, the industry had to move that way. And so I think we're seeing the same thing with 0.04% is fine right now for me, because as and when the use for DEX becomes apparent, then we're already building the core kind of prototypes of that infrastructure. The Union Square put out an article last year I really like, which is the apps infrastructure cycle. So you have some basic infrastructure, and then there's a breakout app, and that begets new infrastructure. So the light bulb was invented before the electric grid, right? And the airplanes before airports and hubs. And similarly, AWS came out of Amazon having a breakout business. Facebook rewrote PHP. So these things, what we're doing in DEXs right now, I think is going to be critical. My first part of my career was in trading, building trading systems, equity trading, capital, fixed income trading, program trading. So I saw how Wall Street was evolving. There's a guy named Seth Marin who built a company called LiquidNet to provide dark pool liquidity for institutional trading. That was an innovation in an already existing industry. And I think DEXs will find their gap as we move from just market. Well, I almost said manipulation. Market, just basically speculative trading to actual, real, true value of the exchanges providing liquidity for the higher layer applications.
Well, I don't want to be too cute, but actually, I think one point that's worth making is, part of what people describe as being really attractive about DEXs is the fact that, pretty much they'll list any asset that people choose to trade. So there's much lower standards. Anybody in the world can trade them. There's limited to no KYC or AML. They trade 24/7. If you think about those features in the abstract, they kind of sound a lot like what are actually the most popular unregulated centralized exchanges, right? So there's a sense in which, if you sort of squint and just don't take in too many of the details, what makes DEXs really attractive is also what makes a lot of the centralized exchanges that are winning very attractive. It's just that DEXs are too slow, they don't have enough liquidity, and there's some fundamental technological limitations to really making them work the way we want. But you can very much imagine a future where more and more of the global exchange volume is tightly regulated, which might just be because of the fact that right now we're still very much in this global Wild West phase of crypto, that drives more volume to DEXs, but also as the technology improves, people figure out how to get the experience of a Binance, but in an actually totally decentralized way. So I think people do want the things that DEXs offer them, but right now they're getting served by these sort of casino-like unregulated exchanges.
But the argument I've heard against DEXs is now you introduce a lot of a massive attack area because of price oracles and smart contracts and all that. So how is it any better than a centralized exchange that can be hacked? Can't a DEX also be hacked technically?
DEXs can absolutely also be hacked. So I think the advantage of DEXs is that, one, because of the fact that anybody can read and audit the code, it makes it much easier for individuals, because you have thousands, tens of thousands of people trading on a DEX if it becomes popular. All of those people have the ability to actually audit the code. Now, it's not to say that they all will. Of course, a tiny minority of them will. But enough people will actually look at that code, as opposed to, for Binance or BitMEX, the only people looking at those code are their auditors and the engineers. And so, you've worked at a tech company. You know that, there are bugs in production code all the time. And only when they get exploited are they actually fixed. These decentralized exchanges also ideally have simple enough architectures that it's relatively easy to look at, okay, where's the code that holds all the money, and can we verify that? So for example, if they're using 0x, 0x has been verified by so many people that it's much less likely 0x has a vulnerability than that Binance or BitMEX has a vulnerability.
I'll jump into it. I think we have the tendency to look at something new has to be better than everything else. Has to apply to all the use cases. But decentralization is a long road, it's a long arc, and we don't use Bitcoin in the same way in every geography or every use case, right? People wanted to have, buy your Starbucks with Bitcoin. I never thought that was a good use of Bitcoin, but it's a great use for remittance corridor, for example, right? And now crypto's coming into Telegram and coming into Facebook, and so it's interesting how that journey goes. And I think with DEX, one example could be systemic settlement, of applications that are machine-based, that are machine-to-machine transaction settling. So they're not traders acting on emotion or sentiment, but they're like, I just need to move this crypto into this crypto. A DEX is a great use for that potentially, and it doesn't need to have the great UI that we're lacking that we saw somewhere else.
Yeah, I think, at least personally, I think DEXs need to win on some dimension 10x better, which it doesn't need to necessarily compete against centralized exchanges. Maybe it's machine to machine, or it's some sort of new dimension. But again, just when you look at the space that's had a long time to develop, very little trading volume happens on DEXs. And I actually pulled the real numbers. So if you, well, it depends how you count real worldwide volume, but if you take out all of Asia volume, which people sort of have whatever, their own bias against, but if you take out all Asian volume, DEXs make up 0.02% of all trading volume, and actually, surprisingly enough, Binance DEX is 40% of all of that. So it's interesting that Binance's version of their own DEX, which some people could argue whether that's even a DEX or not, or how decentralized are they, sort of make up that in totality. And it's interesting because I've actually been I was early pre-sale investor in Binance itself. So one of the things that's just most impressive about the Binance team is just their raw shipping and execution ability. And again, I just compare this to more of the technical solutions, and even of the small volume today, Binance DEX is sort of the lion's share of the DEXs out there.
I'd say, one thing you mentioned, timeline. DEX has really only been around for 3 years. That's nothing in the lifespan of a technology. If you look at digital currencies prior to Bitcoin, people were working on those for 20 years, and every single one was a failure until Bitcoin came out. I don't think DEXs are going to take 20 years, obviously, but I think it is just because it's been 3 years and we haven't seen anything, isn't a super meaningful stat in my view.
Interesting. I kind of want to move to the business model question. So what have you seen be the business models for both centralized and decentralized exchanges?
Centralized exchanges is fairly straightforward. I guess on one hand, you have a percentage of transaction fees. So most exchanges usually take a percentage of taker and maker fees. There's also listing fees and IOs and sort of all that stuff, but kind of roll that all up into transaction fees. And then the more, I guess, innovative or the less regulated ones will do the exchange token. So taking a portion of what those fees would have been and just buying back their own token from it. On the DEX side, I guess I'll let you guys comment on the DEX angle.
It's pretty similar on the DEX side. You kind of have a couple models. One is similar to centralized exchanges. The other is people have various tokens, but those token models aren't super fleshed out. 0x has had a token for a couple of years now, and they're just starting to flesh out the model and have a actual token model with 0x version 3 that's supposed to come out in a few months. Other ones are Kyber has a token associated with it, but I'm actually not sure what that's used for.
Cool, thank you. And so when you're thinking about investing in exchanges, what's your due diligence process like? What are you looking for?
Yeah, I guess ours is fairly straightforward. So we actually made an announcement of investment we made in an exchange called FTX. So it's a derivatives exchange based in Hong Kong, started by the Alameda Group. So Alameda Group, if you don't know, is one of the biggest quant funds in the space. So Sam, who is the founder of that, launched this new exchange called FTX and kind of built it more internally for himself. So a lot of our due diligence actually centered around talking to real traders. So we're friends with a lot of the sort of, I call it crypto native funds in this space, the QCPs, the Alamedas, the Amber AIs sort of the world, and then also the more traditional players looking into the space. So the Jumps, the Tower researches of the world. And we basically just due diligence with the actual sort of real liquidity backstop providers on would this new exchange actually attract them to actually want to trade on their platform, and what are the dimensions that they're sort of most interested in that. So a lot of our due diligence really revolves around the demand side and the customer side of the exchange.
Actually, I want to add a question to this because I've had a hard time falling in love with exchanges and investing them. Part of it is my background in the financial tech industry from early 2000s, and part of it is just seeing that the life cycle of these exchanges. If you're a principal owner, you can make a lot of money very quickly, but you have massive regulatory risk. And I'm not sure what the arc for consolidation is. So actually, to Joey and the panel, I'd be curious, as you look at an investment in exchanges, are you thinking about an eventual consolidation of various players in the market, and is that part of your investment thesis as well?
Yeah, so that's a good question. At Pantera, actually, roughly, we just ran the numbers like a couple days ago. 35% of our portfolio is exchanges by capital invested. And so, the way we think about it is there's, one category of exchange, which is these institutional grade exchanges. So think ErisX backed. Those are ones where, we're gunning for like an IPO with those sorts of companies. I think the other category is ones that are exchanges in foreign geographies. So this is a company that's, trying to create the Coinbase of Mexico or Brazil, someplace where they know the market super well, and they're going to be able to operate there better than a player based out of the States. And those are the two models. For that second model, we anticipate kind of roll-ups and acquisitions. We've seen that a little bit, like Corbett got acquired. And the model usually is in kind of those more developing country markets, there's usually, massive conglomerates that end up just being across a ton of different sectors. This happens a lot in Southeast Asia in particular. And so those are kind of so far those have actually acquired. Corbett, another one acquired, Bitstamp. So that's kind of the current path that I've seen them take. You might envision someday like, a Coinbase or an ICE might buy one of these companies too.
So I mean, at the risk of stating the obvious, the majority of volume in crypto around the world is in Asia. And a lot of the top exchanges, which are these places based out of Singapore or Malta or whatever, they are basically run like casinos, in the sense that like the founders control almost everything, and there's very little in the way of corporate governance or in the way of like shareholders exerting power over the founders. So they are very unlike a lot of the companies that we tend to invest in here in Silicon Valley. The other thing to keep in mind when you're diligencing these exchanges is that, as you guys are probably all well aware at this point, the vast majority of stated exchange volume is complete bullshit. And it's not straightforward, but not trivial to actually verify how much of the volume on these different exchanges is real. And really the only people who are actually equipped to do that, like Chris said, is to talk to actual market makers and talk to people who are actually trading on those exchanges, and do they actually get their orders filled? And if so, with what regularity? That is really the only serious way to actually verify how much of the exchange on these volumes is actually, how much of the volume on these exchanges is actually legitimate.
Yeah, a slight addition to that, like one of the things that attracted me to this space so much is sort of Bitcoin and crypto by nature is 24/7 international worldwide. The center of gravity is actually not necessarily here, just in Silicon Valley. I think for a lot of the like Web 2 and other internet innovations, we sort of had the luxury of everything being sort of within 20, 30 miles of here. But when you actually look at the crypto side, a lot of the reason why a lot of the volume is in Asia is because a lot of the traders actually are in Asia. A lot of the biggest trading funds are in Asia as well. And not just Asia, like emerging countries, Southeast Asia, Latin America. There's a lot of places where it's not, I guess, necessarily obvious, and sometimes we come with our sort of more Silicon Valley sort of bias to it, but it's also good to get a gut check of like where demand is actually coming from.
Interesting. And from a regulatory perspective, obviously the governments are going to try their hardest to fight decentralized exchanges. So how do you think about that challenge over the coming years for these DEXs to exist? Are they even going to let them exist?
I think there's an education challenge and just perseverance. In 2014, when we raised the Series A round for BitGo's $12 million round, the first 2 checks I wrote were to Coin Center with Jerry Brito and Chamber of Digital Commerce with Perry Boring. And I went to DC and I started talking to Congress and the Secret Service and other people about Bitcoin, because Mt. Gox had just collapsed. And so everyone said, aha, we finally have a reason to shut this shit down. And they didn't know how to do it, but education was important. And what Jerry and his team and others have done is put out really thoughtful research and literature that tells a longer narrative and a bigger story than it's just drugs and money laundering and things like that. And so I think with DEX, with offshore exchanges, we have to continue to educate the regulators here and then have a different conversation outside the US about how everything we're doing fits within the existing regulatory framework. Don't invent new regulation for us. We're good. Like we can do this. And if we need to modify it, we'll help you understand that. So it's a challenging journey, but I think the companies that have the larger balance sheets and have more to lose have a responsibility to the industry to try to do that.
Yeah, I have no direct comment for decentralized exchanges, although I'm assuming if you architected a decentralized way in its sort of fullest extent, it'd probably be pretty hard to stop sort of from any one potential party. In terms of centralized exchanges, again, for proof of capital, we tend to be sort of very cross-border, and we really mostly focus where the demand side is coming from. So we actually believe it's way easier to start all these things outside of the US. The US is just so hard from a regulatory perspective because you have a lot of interest that you have to work with. And some of the companies in the space, like Bakkt and others, they've had to raise enormous amounts of capital in order to get that, versus in Asia and other countries, the barrier is much, much sort of easier to get started.
Going to that point about a protocol being truly decentralized, I think one of the criticisms is that there's no DEX today that's actually truly decentralized. Is that true?
I think I really hate this notion of really decentralized and not really decentralized. Like, the idea that decentralization is a binary is just completely ridiculous. Like, decentralization is very clearly a spectrum. And Bitcoin did not start completely decentralized. It started with like a dude and his few friends on a web forum, right? Like, that's what, today we would laugh at that and say like, this is not a decentralized cryptocurrency. Like, one dude owns like almost everything that was ever mined. That's not a decentralized cryptocurrency. All these things take time, and the amount of decentralization that you want is going to be parameterized by how much money you have locked up in it, how long it's been used, and what the actual regulatory risk is. So the reality is, a lot of the reason why regulators are not going after DEXs is not just because DEXs are so censorship resistant and wonderful and hard to break. It's that like they don't care because the volumes on these DEXs are negligible. And you know, for the most part, yes, there's probably some illegal securities being exchanged on these DEXs, but it's at such small volumes and like not concentrated in a particular country. It doesn't give anybody much incentive to go after it. And if they do become bigger, these are questions that DEXs will seriously have to grapple with. But for now, most of what they need to care about is just like, one, minimizing counterparty risk, which is the thing that people fundamentally care about with DEXs, and two, just growing, just getting users. You know, so I think it is probably the right move for them to not worry that much about decentralization right now and just accept being non-custodial and instead just try to focus on growth until it actually matters whether or not they're quote unquote fully decentralized.
I think one thing on that, I take a little different view because I think if you're not kind of, so I binarize decentralization a little bit. I think the binary line is, are you an operator or not under like the regulatory regime you are based in? And so basically it's kind of from the regulator standpoint, in my view, almost like, are you decentralized enough to not have to like say register at the SEC as an example? And so I think that's really important to be at least that decentralized kind of from day one. Because I don't think it's a thing where you can, you know, run it for 6 months and then beg for forgiveness later. That's not how the SEC's operated in this space. And so that makes it challenging, though, because it's much easier to acquire users if you take the Binance DEX route, which is basically a centralized exchange with a few kind of tweaks to it. It's much easier to acquire users that way. But I think at the same time, it's kind of like they're outside the US, so they're playing a different game. But I think if you're in the US, like somebody like 0x, it changes the paradigm quite a bit.
So I totally agree if you're in the US. But I'm yeah.
Well, one small data point on that, EtherDelta, the SEC actually did an enforcement action against them. And EtherDelta, I don't know about the spectrum of decentralization. I kind of hate that term too. But EtherDelta was pretty decentralized. I mean, not like kind of fully all the way. But one of the things that was interesting was actually in the enforcement letter, one of the things they referenced to show that, I forgot the guy's name, the guy was the operator of it, is they actually pulled his subreddit comments. And he was helping people on the EtherDelta subreddit with their support request. And that was one of the things in evidence they showed, hey, you're the one operating the exchange. Look, you're the one answering the support request, which I think was a little interesting that they can go that far.
Interesting. And like when you, just to clarify, Joey, when you say operator, can you elaborate for the audience what you mean by that?
Yeah, so under most regulatory regimes, there's kind of this concept of, are you an operator of something or not? So are you, performing an action that makes the thing function? And like the simplest test, it's not a legal one, but the simplest test, it's a practical one that kind of like at a high level, should work in theory is if you were to walk away and just like stop typing, stop programming, would the thing you built continue to run? Now, it may not like improve over time. It may not be great. It may not be a good user experience, but would it continue to function? And that's kind of how I think about whether you're an operator or not. And so if you look at EtherDelta as an example, the founder is a guy named Zach Coburn is his name. He hosted a website, and he also stored all the orders that users transmitted, and basically operated a server that stored those orders and hosted the UI on a site that he controlled the DNS and domain for. So those are kind of like some elements where even before that action came out, I was like, this guy's probably an operator. And so I think that's kind of like the line that I distinguish.
And do you think the SEC can come after developers? Are developers considered operators?
Depending on what you develop. So this is kind of the really important thing. Zach was a developer. He was just writing software, but he wasn't just writing software. He was like operating servers. He was hosting the software. So the big distinction is like, are you hosting the software or are you just writing it? So an example might be if you take Bitcoin, Satoshi published Bitcoin, and Satoshi actually did run it in the beginning. But you could envision that if, say, like Hal Finney and one other person started running it, Satoshi was no longer operating it. Versus, say, certain decentralized exchanges, the person who created it continues to host some software.
But in Satoshi's case, you don't know who he was. So even if you have his GitHub commits, you can't really identify him. Whereas like every crypto project doesn't have that same element. So can't the SEC still come after you if you coded that protocol?
Well, it depends on whether the U.S. continues to consider writing software under the First Amendment. There's a bunch of historical Supreme Court cases on this, where people have, anything from CFTC stuff all the way to people writing encryption software that was at one point, considered to be weapons or munitions. In pretty much all of those cases, the software developer won. A lot of those actually went up to the Supreme Court level. Now that was like a pre-9/11 era, so whether the U.S. maintains that merely writing software or publishing software is free speech is a little bit of an open question, but I'd like to hope that continues to stay under First Amendment.
And interesting, there are actually a few exceptions for that. I believe writing gambling software is one of the exceptions where software is not considered purely speech. But in general, and I think the CFTC commissioner who commented on that in general there's kind of a presumption that software developers are not liable for if they do not themselves operate the software. But like Joey said, it's a brave new world. So we'll see what people decide when they actually have no other way of getting at some of the folks who operate these exchanges.
Awesome. And so because exchanges, especially in the US, are so tightly regulated, they're very cautious of what coins they list. And so do you think that's going to affect the alt market in the coming boom cycle?
Oh, there's a coming boom cycle.
Yeah,
Good-
what
good
coming
news.
boom cycle? Do you know something we don't?
Somebody tweet that out, Preeti. I am Preeti. That is. It's also another. Every one of these questions seems to be broken down geographically, right? There's a lot of exchanges are looking for volume. That's the test. Can this coin bring volume to my exchange? Or previously, can I get a multi-million-dollar listing fee if I list this coin? I think that that game kind of ran its course for a while. So there's a little more of kind of stability in that, but that means a lot of alts are not going to get the light of day, which opens the door for DEX. Then there's no volume there. So I think it does beg the question of where, how coins, whether it's ICO, IEO, or just kind of launching a token into the wild, how do you think about your relationship with the exchanges and which geos that you go into? And I'm sure you guys have comments on that. I'd be curious to hear your points of view. But I think that is changing, that we're not going to see the plethora of coins listed everywhere with the volume coming in.
Yeah, even with the sort of Asian exchanges like the FTXs, the Binance, the Huobi, the OKs of the world, actually the majority of revenue and I would assume profit, majority comes from Bitcoin, USDT, whether or not you like that or not, and maybe a handful of others. A lot of the long tail sort of alt stuff, like although they kind of have like their spikes up and down, like they don't really drive the majority of the revenue for the exchanges. So like unless something drastic was to happen on the user adoption side, I would imagine that to persist.
Actually, that's a good point. I think we're going to see some new factors coming into play. So, for example, when a large network like Kakao is launching Clayton and can potentially bring distribution to tokens at launch, the exchanges are going to be more interested in those tokens. And also, I mentioned Telegram before. I think that's going to be a game changer. 300 million users having access to this token and where that plays out. So I think as we see larger networks of users come in and facilitate token usage, then the selection criteria by exchanges will update.
Another thing to be mindful of, just in like overall exchange market dynamics, is that, you know, in sort of in the normal finance world, spot markets where you like directly buy or sell the currency are a small portion of overall trading. The majority of trading is in derivatives, and we're now seeing the same thing happen to crypto. So right now, if you look at CoinMarketCap, it looks like spot trading is most of what's happening, but most of the exchanges counted on CoinMarketCap are complete bullshit. And like if you look at numbers that are adjusted for fake volume, the vast majority of volume in crypto is derivatives. It's not spot exchanges. So that is harder to do for like a lot of these long tail altcoins. And so again, like the vast majority of the volume is in Bitcoin, USDT, and these, you know, I think it's largely the case that some of the most interesting stuff going on right now in the quote unquote DEX space is really in offering derivatives through DeFi. So platforms like DYDX and other ones like it are, I think, tapping into a sort of larger trend that's going on in the space that makes them sort of facing a bit of a tailwind in figuring out where trading volume is going to be going in the future.
Yeah, some quick numbers to that. It depends how much of the real sort of total volume you count or not. But the futures markets is anywhere between 1-to-1 parity to the spot market price to like 4-to-1 or 5-to-1 if you discount a lot of the spot market volume. So we actually already see today that the majority of trading volume, again, depending on how you cut it, comes from the derivatives markets. And a lot of the derivatives and futures, like while they're sort of larger in comparison, there's actually a smaller number of them. So most of the derivatives volumes happens through BitMEX, OK, Huobi, and FTX, and sort of a handful of others.
Super cool, thank you. On a similar topic, we talked about what exchanges will list, but there's also a lot of delistings happening. Do you think that's going to continue to be a trend? And if so, how does that impact the exchange's like reputation and image in the public market?
So there will definitely be a lot more delistings going forward. So we're already aware of a lot of these sort of zombie chains that still exist for some reason, but like kind of nobody is using. And I think after the Ethereum Classic 51% attack that we saw last year, there are going to be more and more of these kinds of copycat attacks, especially against proof of work chains that don't have a lot of security. And those are basically direct attacks against exchanges. And so exchanges eventually will want to start delisting some of these assets as they become more insecure. It sort of gets accepted. They're like, okay, nothing's ever going to happen on this chain. Why are we still listing it? I think for decentralized exchanges, it's kind of a challenge to delist an asset but still claim you're decentralized. And so you need like some kind of governance or something really figured out to decide on delistings. And there are a lot of incentive problems with making sure that those work out correctly. So I think listings and delistings are kind of a challenge, but for most of the centralized exchanges, because the vast majority of their volume is concentrated in a relatively small number of tokens, I think over time we're going to see the number of assets listed go down for most of these exchanges as we get farther and farther away from the ICO boom.
Yeah, even more just like I guess to add on to Steve's comment, like even a more practical reality, if you're an exchange operator, I guess more from a centralized exchange standpoint, and you have some random altcoin that has 0.01% of market volume and 0.01% of revenue comes from it, but has 20% of your risk, you're not going to keep it on the platform for very long. So I think even just for like very simple empirical reasons, like a lot of things will probably not exist listed forever. DEXs are a whole different story.
Okay, so we have 5 minutes, so I just want to go with the last round of questions, and the same question for everyone. Do you believe the future is all DEXs, all centralized exchanges, or a mix of both? And second question is, like, what's your favorite centralized exchange and decentralized exchange today?
Will, I think you're starting.
Okay, so mix, and I think the mix should be broken down to institutional trading and retail trading, and then within those, DEX and centralized. And it's just a reality of that certain traders or certain folks who want to have it, the purpose of exchange, have a need to do it in a certain way. They have to operate in a certain way, and that's going to be filled. And the DEX, I think, will fill a very important need. I look at the DEX actually. If I were running in a centralized exchange, I would rebuild my core as a DEX and put the institutional retail centralized layers on top of it, and then eventually I would roll out the DEX as an availability to kind of everyone, thinking about the future of smart contracts, KYC versus smart contracts, things like that. Ultimately, that's the long game, but in the near term, I think DEXs will just start to play these niche roles till the technology is proven and then come in. And my favorites, that's none of your business. No. It'll come.
Yeah, I guess I said this a few times, but to recap, like I think centralized exchanges will dominate spot and derivatives market. However, I think the more hopeful answer is I think the decentralized versions of these, I think will take different use cases that are not necessarily spot and derivative. Could be programmatic, could be machine to machine, could be if gaming or dApps or something really takes off. There's sort of all different combinations and sort of very unique to this market. It's not only for trading, there's sort of all other things. In terms of favorites, again, I'm super biased, but on the spot markets, Binance, on the futures and derivatives, FTX, DEXs I don't use as much.
Yeah, I would say I agree with that. Definitely mixed use. I don't think DEXs are going to compete on spot, but they will compete on new assets and things you can't trade anywhere else. I don't really mean altcoins, but I mean other things, like certain types of derivatives, certain types of bets, those kinds of things. Favorite exchanges, I guess I'd say centralized backed, decentralized, 0x.
Other things like Augur. Yay.
So I think I'm going to take the very adventurous answer and also say the same thing all these guys said. So I think it'll be mixed. I think that as the technology advances, DEXs will primarily really gain their foothold in things that can't be traded on centralized exchanges, like Joey said. But more specifically, I think that as some of these Wild West exchanges eventually start getting sniped by governments, more of the volume that they're serving today will end up having to migrate by necessity to DEXs. And then there's also stuff like synthetics and other things like that normally you can't trade on a centralized exchange that will start becoming available in a decentralized, censorship-resistant way. So as for favorite exchanges, I think CZ is a gangster. So I'd say Binance for centralized, and for decentralized, I think it's not actually out yet, but I think StarkDex is going to be one of the coolest DEXs that we're going to see for a while, which is settled entirely through Starks, which are like a form of zero-knowledge proof.
Awesome. Thanks so much. For anyone in the audience who wants to reach you, where can they reach you all? I guess there's right behind me. Okay, never mind.
Yeah.
Cool. Well, awesome. Thanks for having you guys here. You guys are way smarter than me about DEXs, so I learned a lot. I hope you guys learned a lot. And I guess you can just talk to them after this.
Thank you, guys.
Thank you.
Okay, so that was really awesome. I'm really glad to have these guys, rock stars, up on stage here. And the Silicon Valley Bitcoin meetup is very thankful that they came around.
Thank you, George. This is awesome.